Financial Survival Network, helping you survive and thrive in the new economy. Go to CarrieLutz.com and sign up for 30 free micro trainings on financial survival.
Great news, we've got a sponsor. This show is now brought to you by Miles Franklin. And when it comes to protecting your wealth, you know there's nothing better than gold and silver. That's what I'm buying. I hope you're doing the same. And once you make the decision to buy gold and silver, there's no better place than Miles Franklin. Look, they've been in business 22 years. And the reason I'm a customer is because when you buy, they ship. Go to milesfranklin.com or call them at 800-822-8080 to get a free quote. $14.90 WGCH. This is Kerry Lutz. You're listening to the Financial Survival Network. And if you're wondering how to cash in on high oil prices, how not to just get pummeled at the pump, then my next guest, Jason Burack, has got a new take on it that should help you profit. Jason, welcome back to the Financial Survival Network.
Thanks, Kerry. Glad to be back.
You're mentioning oil companies. And when most of us think of oil companies, when you think of oil, you think of how you're getting hosed at the pump or all this money that you're paying to heat your home, but you can actually profit from them, can't you?
Exactly, Kerry. And I think in a lot of cases, these larger oil companies that we see are not really becoming, they're not replacing those oil reserves that they at the rate that they used to. So like a company like ExxonMobil, they're really transitioning to, they're producing, a certain amount of oil, certain amount of natural gas. They have refining businesses, but, the refining businesses they're selling off, they're not profitable anymore in the United States. The margins have been completely and totally destroyed. And, the environmental costs, and that has, raised the amount of production costs for their refining stuff. And, I think a lot of the oil companies here are just going to have to continue to add oil reserves somehow. I mean, if ExxonMobil's not going to do it, there's going to be more aggressive, mid-tier ones who are going to want to go out and increase production, increase reserves, et cetera, et cetera. And I think this is a great way for investors here. A lot of your listeners are precious metal investors, and the precious metal companies and some, the actual physical metal has been lagging a little bit in the paper price. But I think a good hedge, besides some of these other hedges we've talked about in our interviews, is, investing in the oil sector. I think oil is a really important position in people's portfolios, oil exposure, not natural gas exposure, but oil exposure. And I think that's a good way to protect yourself from what's coming and also to hedge your gold and silver investments, like I said. And I think that's because I see a perfect storm coming due to many, many factors that we can talk about in this interview, why I think oil prices are, we might not necessarily have a large oil spike going forward unless we have an actual Iran war. But I definitely think oil prices are going to, move higher, like in a trading range type of thing where they go, gradually higher.
Right. And why do you think they're going higher?
Well, let me outline this perfect storm scenario for you. And I think there's a number of different things here. Number one, you have a devalued dollar. So you have, all oil is priced in dollars. We have the petrodollar and world's reserve currency. So that's number one. Number two, you have a lot of these old major oil fields like, the Ghawar in Saudi Arabia. You have Canarell in Mexico. You have Iran and Iraq, and some of these other, large oil producers, and you have large depletion rates at these fields, and they're just bringing, the excess capacity that Saudi Arabia is bringing online is a lot of it's marginal, and it's done with fracking, and, a lot of it's heavy sour crude. So they're light sweet crude, which is, this goes into peak cheap oil. This is not, we're running out of oil, we're running out of cheap oil. And, Saudi Arabia is, they're light sweet crude fields, their large ones, are depleting rapidly, and they're bringing on marginal production. So that's factor number two. Factor number three, it has to do with U.S. Refining capacity, which, like I said, the American refiners, they're just not really profitable. So they've shut down, I think, over 700 barrels per day of refining capacity in the United States, which is not a good trend for lower gas prices in the U.S. long term. Number four, has to do with the subsidies. And this is something that really the subsidies are something that really, really bothers me. And, I could see why the governments in these developing countries and OPEC countries do the subsidies. But, if there was free market forces, if there was demand destruction with over $125 a barrel Brent crude, then, people in Saudi Arabia and China and stuff would be forced, if they were paying a true free market price, they would be forced to cut back on their consumption and use the resources more efficiently. But these guys, are paying 30 cents a gallon or $1 a gallon, and no matter what the oil price is. So this is why then we have a scenario where, despite the macroeconomic situation where, we have a recession/depression here in the United States and the Western world, and in those countries, oil demand is still rising very, very rapidly. People are paying cash to buy new cars, and oil demand here in these countries in the Western world and the United States, where more free market forces and we're exposed to more of a higher price, where we're cutting back. So all of these factors are just convening on one at once here. And this is why we are going to have higher oil prices, I believe, trending higher, plus, geopolitics with Iran and some of these other things going on. And plus some of these OPEC countries like Saudi Arabia, they've made a lot of promises for social programs too, besides just the subsidy for the oil to their consumers. They made promises for social programs for their citizens so they won't revolt at the government. So these guys, these are all the factors here that people need to take it into account, and why Wall Street and Washington, the people are saying we can't blame the evil speculators, and they are blaming the evil speculators, but that's not the truth.
Right. So even if nothing happens in the Middle East, no war, no nothing, we just continue on the way we are, prices are going to go higher. Exactly.
And, we're not going to have that super spike then, but they're going to still trend higher. And there's just, until there's real free market forces, and I can make a good argument that there's not even real free market forces here for American consumers, because American consumers do not pay the true price of, the military defending all those barrels of oil, in the Straits of Hormuz to get them out of the Persian Gulf, all the military costs. So that's absorbed, through devaluing the dollar and inflation. But I think one thing that your listeners need to really understand here, and this explains, not only the macroeconomic situation, but all of our money situation, etc., is that the price of oil is really only going up in paper fiat dollar terms. In terms of gold and silver, the price of oil and gasoline over the last 10 years has really come down. It's never been cheaper.
So we actually have deflation when you calculate the price in gold and silver.
Exactly. And this, for even many professionals is mind-boggling. Most professionals who I've talked to, the people who haven't read much Austrian school economics, who are not familiar with, thinking outside the box, they don't even understand this.
So how do you cash in on this trend?
Well, I would say it really depends on the risk tolerance for your listeners here. There's good, solid, dividend stocks out there in the oil patch. There's the Canadian Energy Trust. There's the MLPs, which are the American versions of those. Those are good, solid, safe dividend stocks. They operate pipelines or tankers, very low-risk businesses. And, when they want to buy more assets, they sell more shares to buy more cash flow assets. So, they're not taking the E&P, the exploration and production risk of, a smaller junior producer in oil, where they're trying to go out and risk, wildcat risk a couple $1 million to find a couple million barrels of oil. It just depends on people's risk tolerances, how they want to play things. So I think there's room. I see tremendous value pretty much all across the oil patch here. I think people can't go wrong with a lot of the companies in the oil patch. A lot of the companies are selling, rig like Transocean and some of these other offshore drillers and stuff. They're selling at quite a big bargain.
Right. So there's definitely value out there. And it seems that with the new technologies, fracking and such, and as well as a lot of new seismic analysis tools that are out there, there really is a rush to develop more resources, isn't there?
Yeah, I would agree. But the thing about fracking is that, there's a lot of mixed messages about whether it's safe or not environmentally. And this goes into, one of the things about being a resource investor is you cannot bet all of your capital on just, one area of the country in the United States or one area of the world or one country. So, things could change geopolitically, things can change, with environmental risks. So, as good as some fracking operations are right now, those could be, the production costs in those could skyrocket due to new, EPA environmental assessments. So I think it's important that people understand that there's all kinds of risks all over the world right now, and that they need to, have a geopolitically diversified portfolio besides, diversifying into different commodities, different asset classes, et cetera. And I think this is something important that not enough other experts talk about.
Right. So you have to diversify, and so you need a mix of stocks to kind of protect you if one or two go bad then, huh?
Exactly. And, some of these governments, things could change very quickly at some of these governments. Like, things could have been bad at some of these governments, where there would not have been capital allowed. I could give examples like even in Mexico, I think before 1950, Mexico did not allow, any foreign investors' capital into there to build, mines like gold mines and silver mines, et cetera, et cetera. So, and now Mexico is voted, one of the most safest mining friendly areas in the world. It's probably number one, I would say. So, things can change. This is a very tough macroeconomic environment. Investors are going, they cannot just buy and hold for a long period of time with all of their investments and, set it and forget it, Warren Buffett style. They're going to have to check, political stuff and geopolitical stuff. And, in the cases of the fracking, they're going to have to see, if the EPA is coming out with the new fracking law, that's going to, triple production costs. Because then you're going to see some of these fracking guys and, with natural gas market, you're seeing that with Chesapeake Energy. Chesapeake Energy is just selling off assets like crazy. They've had tremendous losses. They're hemorrhaging bad. There was tremendous stock dilution. And, you don't want to be a shareholder holding that stock all the way down. So I think that's the point I'm trying to make here for your listeners.
Yeah, and you got to take profits on the way up, so you don't have to wind up watching a stock double, triple, and then wind up with losses on it, right?
Exactly. Or if you have the financial education to use options, you can pull equity out of some of your larger publicly traded companies. You can sell covered calls as a strategy. So if you're not getting a big enough dividend in the stock and the stock's had a very big run up, you can pull out some equity by selling covered calls. But that is, that option strategy, it requires a certain amount of financial education. But, if you have the right financial education in place, you're going to do just fine in this environment, I believe.
Yeah, and how long you think the oil run's going to go for here?
Well, we could see a brief correction here in oil. It could move up or down a little bit on some news here, but I don't know for sure if we're going to go into Iran or not. It looks like we could be in there in the next 6 to 8 months, where Israel and the U.S. do go into Iran. If we do, there could be a super spike. But if there's not, I still see a higher trading range here for oil over the next 3 to 5 years because of all those factors that I outlined. And on top of that, over the next 7 to 10 years, I just see a lot of these OPEC countries that, are net exporters of oil. And this includes, Iran, Iraq, Saudi Arabia, Venezuela, etc. I could see them becoming net importers of oil. And then where's the oil going to come from?
Mm-hmm.
Like, how are we going to solve this? So I think the trend is pretty much clear that we're going to see it. If we have a super spike, I wouldn't be buying it there. I would be taking some gains and waiting for, a violent correction there and, build up a cash position on if we do see, a super spike type of thing. But I think, because of all the factors I outlined in this interview already, I think we're definitely going to see a higher trading range in fiat terms, not in gold or silver terms, because I think, gold, silver, and oil are going to take turns outperforming one another. So I think that's why people need to have exposure to all of these key commodities. I think these are the top 3 ones, in my humble opinion, like that people should have as core portfolio exposure. And, you can find those other types of investments, but I think these are 3 of the most key ones for the next, 5 to 7 years.
Yeah, well, that makes a lot of sense. And, we're going back to a time where wealth comes out of the ground. It isn't created, with some financial alchemy where you turn paper or digital, bytes into gold. You're going to have to dig back in the ground, whether it's food, oil, natural resources, a host of them that we need, or gold and silver. So I think it's just part of the trend that people are understanding that the scarcity of all these things we need for modern life, it's really going to hit home soon, isn't it?
Exactly. And, that goes into the macroeconomic situation I see, which is, worsening stagflation, where we see, higher consumer staple prices, higher energy prices, higher food prices. And because energy is the master resource, especially oil, and oil is the master resource, that's going to mean, your utility bills are going to go up, your electricity bills are going to go up, your food bills are going to go up, because the majority of food, requires a certain amount of energy inputs to, grow the food and then, raise the animals if you eat proteins. So these are the types of things that, like you said, they cannot be printed out of thin air. There's a lot of hard work going into them. There's value stored in them. And, they're not something that people can really cut back on too much. I mean, you could trade down a little bit for some of your food you eat, but you're still going to eat a certain amount of calories per day. You're not going to, go from eating like, a couple meals a day to a half a meal a day. So,
yeah, my kids won't be happy about that one. Trust me on that. So, all right, Jason, it's been great having you back on. You're on the right track here because resource plays are the plays for the coming decade. Where do we find you? Where's your website?
They can find my work at wallstreetformainstreet.com. That's WALLSTFORMAINST.com.
All right, excellent. So we'll talk to you soon, and we're going to be keeping a close eye on oil. And I have a feeling you've nailed this one.
Thanks, Kerry. Glad to be back.
Right.